Good evening, Trade Flare family. Welcome back to the Nightly Breakdown, where we break down what happened today in the stock market, as well as give you an idea of what we're looking at into tomorrow. Now, before we head over to conduct a technical analysis of the SPY and 5 stocks, let's look at some key points to get a broader view of where we stand. So the first key point I want to start with is the jobs data. So we had this jobs surprise to the upside on Friday. We saw somewhat of a Goldilocks scenario, not too much, not too little, but just the right amount of jobs improvement to where the Fed's threshold for substantial further progress has not been met yet. So looking at the numbers, the US economy added 850,000 jobs in the month of June, the most in 10 months. At the same time, the unemployment rate went higher to 5.9%, and the labor force participation rate held steady. It was strong enough to bring some investor confidence for the recovery, but not strong enough to accelerate the Fed's timeline, which is good. So jobs added were up, but unemployment rate was up as well. And economists are explaining this by saying that people are leaving part-time jobs to go back to full-time jobs. And they know this because the underemployment rate was down last month, which includes part-time workers who want a full-time job. So overall, my key takeaway from the June jobs data is that it doesn't change the Fed's outlook, and it shows an economic recovery. I think this gives room for equities to go higher. We have ran up a lot, maybe not right away, but going into earnings, we have this jobs data right behind us. So right now, I don't want to be too skeptical or bearish. I do think we could go higher. I think July could be a bigger month than June. It's really going to depend on how earnings come in, as well as the rest of the economic data that we receive throughout the month. Headed over to the next key point, I want to talk about the month of July and the end of the first half of 2021. And overall, we had the best first half of the year in over 20 years. The S&P jumped 16% in the first half of the year compared to 7% decline last year. Historically, July is the month of the summer where the S&P gains the most. This is because of earnings and dividends. Last month, the S&P did 2.22% compared to 0.55% in May. Over the past 12 months, the S&P did the worst in September and October, and over the past 12 months, the 2 months that the S&P did the largest gains were August and November. Last July, we did 5.51% on the S&P after 1.84% in June. Looking at the history, combining that with the excitement from the jobs report and economic recovery, I'm bullish on the month of July as long as we see continued optimism about the economic recovery. But like we talked about, the market's running off of that Goldilocks scenario, so we want not too much optimism, but just right. If the Fed sticks to the playbook, everything can keep running. And as it stands right now, that's how it is. So watch out for the month of July to be a good one. Now headed over to our last key point, which is, as always, our indices and our sectors. The leading indice on Friday was the Nasdaq, closing up over 1%, right behind the S&P, which is up about 0.75%, and the Dow was lagging on Friday, up only about 0.5%. Small caps were rotating on the downside. IWM was down 0.95%. Looking at emerging markets, they closed down about 0.1% as well. So foreign stocks and small caps were not the leaders on Friday. Looking at sectors, the tech sector led, up 1.32%. Right behind that was healthcare and consumer discretionary. On the downside, we had financials and energy closing red. Like I mentioned last week, I like that healthcare sector. It's up again, breaking out of that bull flag. It's headed towards that 130, and I'm watching healthcare. This rotation into earnings is strong, so definitely have my eye on healthcare and tech as they continue to lead. So now that we have a broader idea of where we stand, let's head over to do a technical analysis of the SPY ETF, which tracks the S&P 500 index. And looking at the daily here, we have a long body green candle supported by volume. And like I mentioned last week, I'm drawing this channel out here, and now I'm looking for a resistance at 436. If we do go higher, I bet we see resistance around that 136 whole dollar level. And also looking at the RSI, we're above 70. We're in the overbought zone. That being said, while we break out, we could go higher. We've got earnings, good jobs data, and a hot tech sector. That doesn't mean we'll go higher right away. We definitely should be seeing a little bit of resistance up here from short sellers. Now, if we do go above that 436 level, we're looking at whole and half dollar levels, and at these levels, we're looking at bearish reversal pattern. As far as right now, it's not an ideal time to set up for long. The SPY is definitely a little bit overextended going into Monday, and with a short week, we could see a little bit of a hangover. If we do go lower, we have an easy play for that gap fill from 431 to 430, and then we have a mechanical support at 28.53. That's going to be from our recent 2-day range that we had broken out of last week. But as it stands, we're getting overbought, we're getting up there, so we need to make sure we know where we are, you know, taking the shorter term trades on the upside. Right now is not really a time where I want to be initiating some new longs, but there is still some short term opportunity to the upside, so don't get too bearish yet. So now that we have an idea where our broader market sits, let's dive into the watch list, starting off with Zynga, ticker symbol ZNGA. And this is a game app developer, and I really like this price action. This is a bullish pennant pattern. We've got 3 higher lows and we've got about 4 lower lows. And now I'm looking at this $11 level to break. I like the amount of volume that's been rushing into this one. If we get that break, I'm looking at 11.41 first and then 12.3 at all-time highs. So I'm definitely looking to walk my way up this bullish pennant. Definitely keep your eye out for Zynga. Next up on the watch list is Keurig Dr. Pepper, and I'm looking at this as a gap fill play. And like we saw on Friday with those gap fill plays, they can be really nice. And this one has a nice little gap to fill. This one's also had some unusual options volume, with options volume up over 1,000% this month. So I'm definitely looking to play this gap fill, looking at that 35.50 level to break. Then we can probably go all the way up to fill the gap at 36.7. This is going to be a slow play. As you can see, this thing doesn't move very much, so this could be a nice little slow gap fill play. So watch out for Keurig Dr. Pepper. Next up is Micron, and looking at this one because we had recent really good earnings. Some of the semiconductor shortage issues kind of scared investors a little more as they continue, but earnings were solid for Micron. And even though this is a red candle, this is a hammer candle, and I like that buyers are not letting this thing go lower after earnings. We've got that long lower shadow. We've got volume to support the fact that there were sellers, and if I was a short seller and we went and broke above that 50-day SMA, I'd probably cover, so watch out for that. Next up on the watch list is Disney, and this is another one that had a bunch of call option volume. They're up 120% as far as option volume this month, 143,000 calls and 79,000 puts. And honestly, Disney's been doing absolutely nothing for the past few months. And looking at daily candle structure, we've got that hammer candle. It's supported by volume. Now what I really want to see happen here is a break of 179, fill up to 181, and that's where we could potentially start to break out and break into an upwards trend after this slow downward trend that we've been in for the past few months. So definitely keep your eye out for Disney. They've got a lot going on right now, so this could be a decent play right now. Keeping my eye on Disney. Next up is a bearish trade idea on Apellis Pharmaceuticals. And this is a simple play off of a inverted hammer candle, and looking at the RSI, this is overbought, and this is just telling me this thing needs to take a break, and this thing has been exhausted. Buyers were loving this thing, they made a ton of money, and now it's probably time to take some money off the table. So I'm looking at Apellis Pharmaceuticals to the downside. The first target's going to be at 66 the whole dollar, and that's going to be the top of this range that we just broke out of, so I'm definitely looking for that short-term trade down to $66. Next up on the watch list, I'm looking at Johnson & Johnson, and like I said, I like the healthcare sector right now. So nice candle structure, long bodied continuation green candle with a lot of volume, and as we look right now, I think we could go head up to that 172 level, which will be right around where our resistance trend line's at. The volume is supporting this move to the upside, the sector is supporting this move to the upside. We've got earnings right around the corner, and this one has been leading the healthcare sector, so definitely keep your eye out for Johnson & Johnson going into the next week. And that wraps up tonight's nightly breakdown. If you enjoyed the video, if you gained value, or if you learned something, make sure you hit the like button, and don't forget to subscribe so you can get notified whenever we post any live or educational content. If you're looking to join our team and be surrounded and motivated by our online community of traders and investors, as well as gain access to trade signals that let you know whenever we make a trade, check out the link in the description below to join our Discord, gain full access by upgrading to TradeFlare Pro, get half off your first month using the discount code TFPRO2021. But don't be mistaken, we are not financial advisors, and none of this is a recommendation. The stock market is risky and you could lose money, so use the information inside these videos at your sole discretion. And as always, you cannot forget that time is your most valuable asset, so quit wasting it. Get up, get out, and go get it, my friend.